Greetings traders and welcome back to another In-Depth with Chris episode. In today's discussion we will be talking about the importance of the 52-week high and the 52-week low. This is often used as an important indicator for traders out there, so we're going to go into all of the information about the 52-week high and low as well as how to find it. But before we go any further, if you haven't already, please do me a favor, click that like and subscribe button down below so I can keep coming out with content for you all out there to help you get closer to passing your Gauntlet Mini goal. Now, without further ado, let's dive on into that information and learn about the 52-week high and low. The 52-week high and low is important to traders due to the fact that it acts as a reference point for establishing an idea in relation to where price of whatever it is that they're analyzing currently is. As you work your way forward into the high and low world, the first thing to start off with the 52 high and low is understand how it's calculated or what exactly it is. And one can really often interpret the 52 high and low just simply as the maximum and minimum price level that a particular asset reached within that past year, generally speaking, meaning 52 weeks in a year. Now, this isn't the case, however, and we need to consider the closing price to actually determine the correct 52-week high and low. So as we take a look here, we have an example of how the 52-week high as well as how the 52-week low is calculated. And at the end of the day, the thing that is taken into consideration is where during those periods, period 1, period 2, etc., where those periods closed. We're taking a look at how high something closed, and we're taking a look at how low something closed, not just taking a look at how high something reached during the wick portion of the candle. The 52-week high and low can be useful for several trading strategies. An example would be when the price manages to rise above the 52-week high, it might signal a breakout, prompting the trader to potentially buy in hopes of riding that new upwards momentum. And similarly, if price were to fall below the 52-week low, it could indicate an opportunity to sell for the converse reason, hoping that there's now an influx of that bearish momentum. For stocks with a history of low volatility, the 52-week high can act as a resistance level, and the 52-week low naturally can also act as a support level, which means that as these areas are approached, a trader might actually be looking to do the opposite. They might be looking to use that high as a resistance point and short near the high and look to go long near the low. This chart shows a 52-week price of Amazon shares, and in the initial stages there was an uptrend, as you can see on the left side of the chart over here, but since July the price has been relatively range bound. Due to the fact that price has been range bound for some time and has not yet returned to our high or to the low that's currently being displayed, a trader might look at this and think that there's going to be a rather substantial event to occur when we do approach the high or the low. Whether it be strong resistance or support remains to be seen, and we would identify which is being shown based on how price is responding when it returns to those 52-week highs or lows. The process to finding a 52-week high or low is relatively straightforward. The first thing that we need to do is just find what it is that we want to analyze. Sounds simple, but that is the first step. Then we want to go ahead and look into the summary section for the 52-week high and low, because in many cases the 52-week range is provided in the summary section of most platforms. However, if it's not, then we go to step 3. Next, if the range is not provided, we want to ensure that the price chart shown is for that 52-week period, because if it isn't, then technically we're not looking at the 52-week anything. We're not looking at a 52-week high, and we may not be looking at a 52-week low if we're being bamboozled by information outside of that 52-week or under that 52-week period. Once we've done that, we're simply looking for the highest or lowest point that price has closed in that 52-week window. Like every technical indicator, the high and low does not necessarily guarantee how a price might behave, and there's two cases to discuss. The first case is when an asset is in a consolidation phase. So when price is trading in a range-bound manner, one would generally expect the 52-week high to function more so as resistance, and the low will generally function more so as support. So that means if price is trading very close to the low, then we might expect price to increase, meaning we might look for a buying opportunity. If price is trading very close to the 52-week high in a consolidation period, then we might be in anticipation of selling with an expectation of resistance to be shown near that high. Case 2 is when an asset is in a breakout phase. So as we've discussed in the past, if price were to exceed a particular area of importance, in this case, a 52-week high, if price went past a 52-week high, that would indicate a breakout in the price of whatever it is that we're analyzing. And a trader could in turn look to follow this momentum. As the area is broken and as individuals realize that we're reaching new highs, it can spur on the increase of buyers in the market trying to take advantage of that newfound pressure that's being shown, that newfound bullish momentum. The same goes true if it were to break through the bottom of a 52-week low, but in that case would be looking to sell to take advantage of that momentum that allowed us to pass through and set new lows. When a stock price or the asset price is trading close to a 52-week high, traders will generally expect the price to trade lower in the future shortly thereafter. That's the general consensus. Most traders aren't automatically expecting a breakout when we are approaching a 52-week high or a low for that matter. And as a result, many are willing to sacrifice the potential of future profit from a break for the expectation of that reversal. And a reversal can be a very powerful intraday strategy for a trader, and I strongly recommend diving deeper into the hole if that's your preferred style of trading around the 52-week high or low reversal trading styles. It's something that can be very interesting, very profitable if done correctly, but once again, it is not without flaw because in the anticipation that you are expecting that 52-week reversal and the market finally breaks and sets a new high, it can be not so good for the trader that bets incorrectly. Let's take a look at this graph and see how the 52-week high and the 52-week low functioned as far as when price returned to those areas. On the left-hand side, we found a 52-week low around this divot here. Now, we never fully returned to this level. However, as we reapproached it, there were multiple times where support was found the closer we got. So this is an area that might be worth paying attention to for 52-week high traders in expectation of support to be found, just because of how resistant price has been as it hesitantly gets towards that low. Then on the right-hand side of the screen, when we set our 52-week high very recently, every time we returned, we continued to find that resistance. The price came up, rejected, price came up, rejected, and it is an area that could very well function as a nice trigger point to either scalp some small moves or possibly expect a large reversal due to how price has currently been acting. On this graph, we can really see that the 52-week high functioned as a beautiful area of resistance, triggering a very strong double top. We found our way back up to this area and crashed heavily from it, never so to return and only to break future areas of support and fall lower. The 52-week high in this case functioned as a beautiful reversal point, and the 52-week low over here was very, very close to being an exact example of how a double bottom can form around that low period. It extended just a little bit beyond, and due to the nature of the graph being an image, we can't really break it down on a granular level, but we'll go ahead and assume here that the 52-week low also functioned as a beautiful double bottom, triggering a nice bullish rally off of it. In this case, we have a high that is very lonely. This is a price point that price has just not even come close to returning to. And we have a low that we just recently set. So as far as watching action to be caused by a 52-week number, the low is going to be the one that most likely will be touched first because we are a lot closer to it currently than we are to our high. However, both of these areas are relatively untested at this point. We know that we bounced up from the 52-week low setting point, and we know that we crashed down from the 52-week high setting point, but that's it. So in this case, we would like to mark off these levels and pay attention to how price acts around them when we finally do approach. Maybe we will climb up to the high, maybe we'll fall immediately down to the low. Hopefully your graph doesn't look like this because this is ridiculous, but you get the idea. In conclusion, despite the fact that a 52-week high and a 52-week low seem like relatively simple pieces of information, they can be incredibly powerful when used in conjunction with outside analysis to give yourself some insight in how price is behaving or about to behave as it approaches the high and the low of that 52-week period. There's something magical that happens at times around those 52-week highs and lows, and the only way you'll know is if you spend some time on a demo account checking out how price responds around them. But until next time, folks, please do me a favor if you haven't, click that like and subscribe button down below so I can keep coming out with content for you all out there. But everyone else, happy hunting, happy trading. I'll see you all very soon. Bzz.